The question that everybody's asking, how is it that the Federal Reserve has increased interest rates at the fastest pace in almost 100 years, yet the stock market is at almost all-time highs? That is what I'm going to answer for you today, because I just figured this out and it's mind-blowing. So a quick thing, you should know why interest rates have such a severe impact on the stock market. So when they cut interest rates, it encourages borrowing, and to borrow money is the creation of new money that was not otherwise in the economy. So a bank lending is creating new money. Now, when this happens, it puts more money in the pockets of consumers and businesses because they have lower debt payments. This creates more consumption on the consumer's end and more revenue for the businesses. So new businesses start, more jobs are created, more spending occurs, and it's a feedback loop. And this causes people to borrow more money to buy stocks, take out mortgages at lower rates, and puts upward pressure on asset prices like stocks and mortgages, creating the wealth effect where people feel like they are literally richer because their 401k is higher than it's ever been before, their equity in their homes higher than it's ever been before, and people spend like crazy in these environments. And there's virtually no incentive to put money in a savings account during this time because everything you look at around you is going up in value. You probably remember back to 2 years ago when the stock market was ripping higher every day. Every day people were talking about how much more valuable their house is than it's ever been. And people felt like an idiot having money in a savings account. And in this type of environment, unemployment rates are usually incredibly low because businesses have enough money to hire a ton of people. Now, on the contrary, in a high rate environment, it discourages borrowing. There's higher debt payments. Something you have to really wrap your head around is paying off debt is the destruction of money because it's taking money that could have been spent elsewhere and paying off debt with it. So it's taking money out of the economy and shrinking it. Consumers and businesses have less money, so there's less consumption, more corporate debt, higher corporate debt payments, and this creates a situation where people have to get laid off, people are saving money, not spending the way they normally would. You know, imagine if you had an adjustable mortgage rate and it went from $1,200 a month to $1,700 a month. Are you going to be looking at your vacation the same way that year? Are you going to be spending as frivolously, or are you going to be tightening your budget? So imagine that times millions of people, because when the federal funds rate goes up, it impacts everybody, whether it's your credit card payment, your car payment, your mortgage payment, especially if you have an adjustable rate. That's how everybody got crushed in 2008. With all that aside, that creates the question, again, how is the stock market almost at all-time highs when we've increased rates at the fastest pace in over 100 years? Just look at this chart. So it shows in the yellow here. Look at the pace at which we went to 5% for the interest rates versus in 2008, it took us almost twice the time to go 20% lower in the interest rate increase. So here's what the mainstream media is talking about as far as the answer goes. And I call this the basic bitch answer because it's easy to see that these 7 stocks that they call the Magnificent 7 are carrying the market. So check out the stat. The Magnificent 7 make up 28% of the S&P index and have contributed almost 65% of the S&P index year-to-date return. So this is where all the money's been piling into, yada yada, we know that. This goes into this next chart. So it shows the large companies, medium-sized companies, and small companies. And look at the discrepancy. So the S&P up 18% on the year, largely because of those 7 companies. The Russell 2000, mid-sized companies, up 7%. And then micro-cap companies, the small companies, are at negative 1.8%. But why? Here's why. Here's what the mainstream media is not talking about. So let's call this the lag effect. So the graph below shows each rate hiking cycle since 1981 and how long it takes for the market to actually go down and crash after the Fed stops hiking rates. Because contrary to popular belief, the market, at least since 1981, has never started going down during a rate hiking cycle. It's always been an average of around 11 months after. So you can see here, it took 15 months in 1989, took 8 months in the dot-com bubble, took 17 months before the great financial crisis in 2008. It was 17 months between when the Fed stopped rate hiking and when the market actually started crashing. And there's another one, the 2020, that flash crash during COVID, that took 10 months after the rate hiking stopped. So right now, the Fed just announced they're pausing rate hikes. This is an average of 11 months that's taken historically for the market to crash after rates stop hiking. So historically speaking, we have at least 8 months to go, right? Let's see. Today's sponsor is American Hartford Gold. Guys, I've always been a huge fan of gold. Let me tell you why. Governments around the world are actively creating a central bank digital currency. The Bank of International Settlement says 93% of central banks are working on one, and 18% plan having one in the near future. That is why I'm proud to mention our sponsor, American Hartford Gold. American Hartford Gold will ship physical gold and silver directly to your door, or they can set you up with a gold IRA and a 100% free IRA rollover, free storage, maintenance, and insurance for up to 3 years. They'll show you how to protect your savings and retirement accounts by diversifying your portfolio with physical gold and silver. American Hartford Gold has earned a 5-star rating from thousands of reviews and an A+ from the Better Business Bureau. Tell them I sent you and they'll give you up to $5,000 of free silver on your first order. Click the link in the description or call 866-430-9194. Again, that's 866-430-9194 or text ACETO to 65532. This next one, huge deal. Companies do not start losing money from rate hikes until they have to roll over their debt and take it out at the actual rate that it is today. So companies are still paying their debt at the rates they took out their loans on in 2020, 2021, to the point where they're actually making a profit right now in the spread. So in 2020, 2021, all these big companies took out huge loans at 0 to 3% interest, and they basically put it away in a money market account in case they needed it. Now today, rates are at around 5%, but they're earning around 8% interest on this money. You can see this graph right here in the red. This is the net interest payments from their savings accounts. Then the blue line is the federal funds rate. So during this whole rate hiking cycle, they've still been making a profit. So they haven't felt the blow of this yet. Now this chart here with the yellow circles, you can see their net interest payments always spike a couple months after the rate hiking stops. Pretty similar time span to that chart that we showed before with the 10 to 15 month cycles. So what we're seeing right now is historically normal. Now this shows what the companies are in for. This first bar here, 2023, around $500 billion in debt payment for companies. The next year it's going to be around $800 billion. Then 2025 it's going to hit $1 trillion in corporate debt payments. 2026, $1.1 trillion. Then by 2028 it's going to be around $1.3 trillion in corporate debt payments. This chart here shows what the companies are in for in the immediate future. There's a jarring spike in the interest payments they're going to have to pay on their debt when they have to roll it over. Now, from the consumer side of things, look at what's going on with credit card debt. The average credit card interest payment's gone from 15% to 20% in just the last year. Now that's what I mean by money being taken out of the economy. So that's money that could have been spent elsewhere being put towards debt payments, because anybody who's used a credit card before knows how bad and severe those interest payments can be once the adjustable rate kicks in. And guess who controls that? The Federal Reserve with the federal funds rate. That's why U.S. consumer credit card debt has reached $1 trillion for the first time in history just a few months ago. Now, perhaps the most important thing of this whole presentation, the GDP plus chart. This is probably the strongest indicator of whether or not we're going to have a recession in the immediate future. So the GDP plus is combining the GDP, gross domestic product, with the GDI, gross domestic income. So any time in history when there's been 2 consecutive negative quarters of GDP plus, it's been followed by a recession. Guess what we've just had? 2 consecutive quarters of negative GDP plus, because people are getting absolutely squeezed by inflation and by higher interest payments, that their income is shriveling up as GDP is slowing. So the main takeaway from this is that there is a clear, logical reason why the stock market has not been impacted by higher interest rates just yet, because revenues are still high, earnings are still high for companies, so the market has not reacted to the higher payments yet, because the new interest rates have not set in yet. They're still paying the cheap 2021 interest rates. But in probably 6 to 10 months, there's gonna be an economic hurricane, unlike anything that we've ever seen before. Now, if you got value out of this video, if you enjoyed it, definitely subscribe. Check out this playlist here if you want to know more about what I talk about. Connect with me on Minnect if you want to learn how to grow your own YouTube channel, because I was quite successful growing my own last year. In just my first year, I gained over 40,000 subscribers, and Jake Paul only gained 20,000 in his first year. So obviously I did better than him. So if you want to grow your own channel, hit me up on Minnect. Thank you for watching. I'll see you later.